You see, we all want to be in a position to grow our wealth. Therefore, we invest in assets that climb in value over time. But it's a very natural human urge, and it's this desire to not want to have losses, that people do much more work to avoid a loss than they will to gain an opportunity, or to gain, even in games that involve just money. People, once they feel like they own something, will go to tremendous lengths to avoid losing it, and yet they won't go the same length to gain something equal. So with that, we're going to talk a little bit about how the market's been climbing, how the market may be at new highs, and what that means to you. So we're first going to take a look at, and we looked at this a little bit last time in a different format, we looked at the list of returns of different portfolios and how unoften they post negative results. What I want us to do is we're just going to look at two of the major market indices here in the US, the S&P 500 and the Russell 3000. So if we can go to my screen here, we have the S&P 500s on the left side of the screen with the ever so ominous 2008 as our first year, growing through the end of 2018. Now, a couple things to note, by the way. 2008 posted a negative 38.7% rate of return on the annual, though it dropped farther than that between September and the end of the year. Okay, it dropped extraordinarily fast, and it had grown up to that point in the year. So we're only looking at calendar year returns. So one of the first things to notice is you could have a lot of really bad days if you look at the market every day. Like almost half of all the days you look at will have negative performance daily. It drops to being closer to like 35% of all days if you look at it monthly. And if you look at it annually, it's even less than that. So we're looking at annual returns, the appropriate time horizon within which to look at, it was a year or longer, to look at what a portfolio is doing. In this case, S&P 500 versus Russell 3000. Russell 3000, much broader index of US-based companies. S&P 500 of almost all large cap growth stocks in the United States. Well, here's what I want to point out. We've got all these years going on. We have 38%, 25, 14, negative 0.9% in 2011. We have a few negative years, several positive years, ending in a negative year. Now, let's just take the average of all of those. Now, remember, when people talk about it's a new market high, they are freaking out a little bit. Why? They're freaking out because they think the market's going to drop because it's been too hot. It's been overperforming. The market's doing too well. Now might be the time to get out. We haven't had a real big down year in quite a while. Okay. Well, if what we're thinking it's going to be is the next down year is going to be another 2008, that's the only 2008 that has happened, like downturn like that on the world economic scale for the last 40 plus years. Okay, we just hadn't had anything like that happen before. Not saying it couldn't happen again, but even if we look at only a academically allocated, globally diversified portfolio, it was totally recovered in 24 months. Now, the S&P 500 and the Russell 3000 are not diversified enough to allow rebalancing and purchasing of other asset classes to get the job done so that you get the chance to have the full rebound. This is S&P 500 having the lost decade is a very real thing from 2000 through 2010, which we're not getting into today. We're just taking the most recent 11 years. Now, if what I did is I averaged the last 11 years returns in just the S&P 500, it's 7.15%. So let's give ourselves some new context. Instead of people having the feeling it's higher than it's ever been, and it has, like meaning the index values are bigger than they've ever been, like the S&P 500 is at this level, Dow Jones Industrial Average is at this level. That's normal because the numbers are bigger. It's been compounding. So it feels a lot bigger than it was just 10 years ago. But how fast has it been growing? Well, if we expect the S&P 500 to have yielded about high 10% or low 11% over the last 70 years, then we look out and we go, Well, it did 7.15 in the last 11 years. I don't know about you, but that doesn't seem like an overheated, overvalued economy. It seems like a pretty normal rate of return for the last 7 years, and maybe there's some room in reversion to the mean that maybe it will go higher than that. Now, let's say we take out, if we want to call it an outlier, the S&P 500. From the beginning of that, now we're just looking at a 10-year horizon of time, 2009 through 2018, it's 11.74%, only slightly higher than the 70-year history of the S&P 500. Again, we're not seeing it over the last 10 years that's been doing 18%, 25%, something ridiculous that then says there's going to be some kind of massive reversion to the mean. It just isn't in evidence. Now let's look at the more broad index of the Russell 3000, and we see something very similar, 6.74% over the last 10 years. And if we just take out the 2008 downturn, we're still 11.26, a very real and normal return for an all equity US-based index. That is total, it's just normal. This is not like we're high flying way above the clouds to be able to produce these returns. Now, we could also, if you wanted to, you can look in the lower right-hand corner of this Excel spreadsheet. I'm just doing a quick highlight, and we can see the average is 10.6 if we took just the last 5 years. Again, this is not wildly out of pace with the market. If we wanted to avoid the two big recovery years after 2008, and we just take 2011 through today, we have an average of 9.64%. Again, this is the horizon of time where people are saying, well, we haven't had a big market pullback. We're probably going to need to really have a big negative coming. Again, I just don't see that in evidence. I see it in opinions. I see it in the stories people tell about what might happen to our investments. But I don't see in evidence that we're somehow operating in a massively overheated set of returns for equity investors such that we should really be watching out for the big downturn. I hope you enjoyed today's video. Thanks for watching. Be sure to subscribe to our channel, ring that bell, and by the way, make sure to share this video. I don't know if you know this, but my cyborg body runs 100% on YouTube views and likes. Please don't let my batteries die.